We have a question here from a new subscriber saying that he often hears us refer to technical bounces from key support or resistance areas, and says that very often when we mention in our videos that price might bounce from key areas, they very often do, and ask why we can't trade some of these bounces. So the example given in the question is today we highlighted that level coming in on the S&P 500 at the 32,100, and the other support levels highlighted in some of the other major indices as well. And we highlighted that 3200, saying that watch out for a possible bounce here from the upside because it is a key level. And the market did bounce to the upside. And the question is, could we have traded that bounce to the upside? So thanks for the question. So let's quickly walk through this and share some thoughts. You are right that we do often mention key areas where we could see price reacting from at those key levels of support and resistance, or key psychological price levels. And you are right that oftentimes we see price bounce as expected from these levels. But we've never mentioned that you can't necessarily trade from these areas as bounces. Trading, small technical bounces from key resistance or support areas is something that many scalpers do. That basically specialize in trading and taking profit on those, or making profit from those small bounces and blips from those key levels. But there is a couple of caveats to keep in mind of something like this. The idea around these types of trades are the expectation that key levels of support and resistance, will often have sometimes limit orders sitting at those key levels, resting at those key levels, and where you have new traders stepping into the market, or maybe some profit taking on moves to the up or to the downside, and that can see some profit taking occur. And as such, we often see those small technical bounces occur from those key levels. And when you time these correctly, sometimes they can be a very simple strategy to bank easy daily pips, if and when we reach those key zones where we think there will be a lot of key interest in the market. Now, again, these can be key support and resistance areas, key psychological price levels. Sometimes even daily pivots can react that way. Now, as with all things, however, there's also always a catch when it comes to trading, and that, of course, is that these bounces are not going to work all the time. Your win ratio is going to be much lower than you think when you try and trade these types of things, and for that reason, you're only going to want to look at trading these key bounces when you can get at least a 1 to 2 or 1 to 3 in terms of risk to reward. That means that if you see a potential bounce, let's say like this one from that 3200, if you see a potential for a bounce here and you place your stop, say, just below these most recent lows, maybe over there, you should at least have space to the upside for a 1 to 2 or 1 to 3, maybe even more, because you're going to win a lot less than you lose when it comes to these types of bounces. Also, when trading technical bounces, when they can be more profitable, is when you have a session where the market doesn't really have any major drivers or any major catalyst moving prices. Then looking at purely technical bounces can be considered, but there's always the risk that when the market doesn't have a specific driver, that the market can just trade range bound. And even though a range bound move from this level to that level can be profitable, what happens when you have a key level that's stuck in an area like this? Let's just highlight that level over there. Can you imagine you trading this and the market is going down through it and up and down and through and down and through that chop? I mean, you don't want to take 10 trades and lose all of them in a choppy environment. So it can be traded. Many traders do trade that way, but definitely not without its risks. And there's always going to be risks associated with any type of trading strategy. So just be very well aware of that before you trade something like this. Can be a risky one. When you try and trade with these types of moves, always try and trade in line with the higher the macro fundamental bias for that particular instrument that you're trading. And normally, when you're trading into that bias, you're going to have a bigger opportunity to profit from these bounces, because you can expect the market to find some key bias at these key levels if your macro fundamental bias is pointing to the upside. But of course, sometimes the market doesn't respect even the macro fundamentals, and it can just chop around and basically chop you up. Now, there was a time a while back, a couple of years back, where I spent most of my time trading these types of scalps, but I just found it very, very exhausting and time consuming and also stressful, because you need to watch those positions like a hawk every single second, because there isn't a lot of conviction in those trades, right? If you're trading that way, when you have conviction in a trade, you can sit through some drawdown, you can sit through some pushback. But when you're trading it as a pure technical bounce, there's absolutely no conviction there. You're basically hoping that there's counter orders sitting at that level that should see the market bounce from there. So it can be quite risky. I mean, when you compare that to the move in today's session, the reason why the market moved lower was the overall risk off turn that we had in the market. So yes, it bounced from that level, probably due to some profit taking, and it is a major level. So we probably had some new buyers stepping in here. So it was a good level to expect the bounce from, but it wouldn't have been a high conviction trade by any means, if that makes sense. Unless, of course, you were waiting for that specific 3,200 level to buy from. That's a whole different story. But if you're trading it just as a purely technical bounce, you're going to need a lot more conviction in these types of trades. So, yes, you can trade these levels. A good example of this was a trade that I took last night, actually, on the euro dollar. So we had the FMC, and when we spiked through that trend line, spiked through that 118, and I actually took a technical scalp to the downside, and traded that for a couple of pips. I think I took it off at these prior highs. It was just a small scalp to the downside, expecting some resistance before potentially pushing through that level. So, sometimes we do trade those type of moves. If it's a level where we have a lot of additional conviction in that we will see some form of reaction, when it's a key technical level. But when you are trading these types of things, make sure that you're not using any leverage on these trades. For me, when I take these types of trades, I'm probably not even risking 0.25%. It's going to be very small risking trades, because your win ratio is very, very low. So just keep that in mind. Yes, it is a possibility. It's certainly something that a lot of traders do focus on from a scalping point of view, but it's definitely not going to be a high conviction trading strategy, and it is probably going to be one that causes you a lot of stress. But certainly one that you can try for yourself. So I hope that helps. Any other questions, please don't hesitate to let us know.